This isn't a rally, it's a reset. Silver is holding above $51 an ounce. Gold is hovering near 4,162. That calm is the contradiction. Prices look stable, almost boring, while the forces underneath are anything but. If you earn, save, or store value in currency, this isn't market trivia. This is about what your money quietly loses when systems stop behaving normally. By late November 2025, precious metals were not pulling back. They were holding elevated levels. Major financial institutions adjusted expectations upward, not downward. JP Morgan Private Bank pointed to gold at 5,300 an ounce in 2026. Bank of America targeted 5,000. UBS revised repeatedly from 4,200 to 4,500, then 4,900. When large banks chase price instead of leading it, the repricing is already underway. But here's the part nobody is saying out loud. This move isn't driven by panic yet. It's driven by recognition. Silver above 51 isn't excitement. It's acceptance. Because the real signal isn't how fast prices rise. It's why they refuse to fall. What's happening now didn't start with a headline. It started quietly, with prices that stopped behaving the way people expected them to. Silver didn't crash after touching the low 50s. Gold didn't retreat after crossing 4,000. Instead, both stalled at high ground, as if the market was waiting for something else to catch up. By the end of 2025, silver remained above $51 an ounce, while gold traded around 4,162. At the same time, large financial institutions began projecting much higher future prices, not as outliers but as a cluster of agreement. This wasn't a single forecast, it was a pattern. Revisions moved in one direction, up, and they didn't come from speculators. They came from institutions that usually move late and speak carefully. That combination suggests this isn't about short-term trading. It points to a broader shift in how these metals are being valued inside the system. But here's where the framing matters. If prices are already high, why are forecasts still rising? What information is being absorbed now that wasn't priced in before? That question is the key. Because once you see the pattern, the next move stops looking random. The claim sounds extreme, but the behavior supports it. The market is no longer treating gold and silver as insurance. It's starting to treat them as benchmarks. One major signal is how forecasts kept changing after prices already rose. UBS didn't issue a single bold call and stop. It revised upward multiple times, first to 4,200, then 4,500, then close to 4,900. Those revisions came after gold had already moved, not before. Silver followed the same logic, with expectations shifting toward $53 by the end of 2025 and testing $60 in early 2026. That sequence matters. It shows price-leading narrative, not the other way around. When analysts chase price instead of anchoring expectations, it suggests something fundamental is being reevaluated in real time. Notice what's missing here. There's no talk of bubbles. No urgency about overheating, no warnings about excess. Instead, the language stays calm, almost resigned. That's unusual, because historically, when assets run too far, institutions rush to cool expectations. Here they're doing the opposite. This is where the story flips. The question stops being how high is too high and becomes what broke that made these levels feel normal. Once prices normalize at levels that used to feel extreme, escalation doesn't arrive as a shock. It arrives as routine, and that's exactly what's happening now. Silver is entering its fifth consecutive year of structural deficit. Supply pulled from above-ground inventories is being consumed faster than it can be replaced. Industrial demand isn't easing, it's expanding. Demand tied to artificial intelligence systems, military applications, and especially solar energy keeps pulling metal out of circulation. This isn't new demand replacing old demand, it's additive. When a market runs multi-year deficits without a price collapse, it means the clearing mechanism is failing. Prices are no longer discouraging consumption. The comparison that matters isn't to last year, it's to earlier cycles. In the past, deficits were temporary, mines caught up, demand cooled, prices corrected. This time, production can't scale fast enough, and consumption is locked in by policy and infrastructure. Here's why that's dangerous. Once a material becomes essential to long-term systems, price stops being a control lever. It becomes a consequence. And here's the normalization that shouldn't feel normal. Silver above 50 is no longer treated as a warning. It's treated as a base. So if supply stress is already baked in and demand is still accelerating, what happens when another pressure layer gets added? The stronger evidence comes from where the strain is no longer theoretical. It's physical. Demand from solar energy alone is projected to surge dramatically, climbing from roughly 240 million ounces today toward 450 million ounces by 2030. That single use case would absorb close to half of annual global silver production, and that's before accounting for electronics, batteries, medical use, or defense. This is where the contradiction becomes impossible to ignore. Public messaging still treats silver as abundant, but industrial planning is behaving as if it's scarce. When future demand is effectively pre-allocated years in advance, price no longer reflects today's supply. It reflects tomorrow's shortages. Now notice the mismatch. Mining output isn't exploding. New projects take years, permits take longer, capital stays cautious, yet consumption is accelerating on a fixed timeline driven by energy policy and infrastructure rollouts. Here's the detail that changes everything. Even if prices rise, industrial users can't simply stop buying. Solar panels don't work without silver. Military systems don't pause for price corrections. AI hardware doesn't scale back because metal got expensive. That's the contradiction. Prices are supposed to ration demand, but here demand is locked in. So if silver can't slow consumption and supply can't catch up, the pressure doesn't release. It transfers. Where does it go next? Pressure like this never stays isolated. It starts stacking. Monetary policy uncertainty is now adding a second layer. Markets are pricing a high probability of interest rate cuts, yet internal divisions have left policymakers constrained. In a scenario where decision-making stalls, rates don't move at all. They freeze. At the same time, confidence in currency management weakens. Capital hesitates. Volatility increases. And real assets quietly absorb the spillover. When action is delayed, markets don't wait. They reposition. A system that can't respond quickly enough creates a vacuum. And vacuums pull capital toward anything that doesn't require permission, votes, or credibility. Now stack the pressures. Structural silver deficits, locked-in industrial demand, and a monetary system that risks paralysis at the exact moment flexibility is needed most. None of these forces alone would break the market. Together they compress it. This is where speed starts to matter. Moves happen faster. Liquidity thins. Small disruptions carry oversized impact. And here's the question that forces everything forward. What happens if this continues? At this point, the shift stops being theoretical and starts landing in real life. Not for banks, for you. When markets freeze or misfire, ordinary people feel it first through friction. Things take longer, costs creep higher, access quietly narrows. As physical silver markets tighten, bottlenecks form away from trading screens. Refiners get overwhelmed. Dealers struggle to move inventory. Secondary markets slow down. Assets that should be liquid suddenly aren't. That matters if you're trying to sell something you assumed was easy to convert, or buy something you thought would always be available. In stress systems, not all assets behave the same. Some stay fluid, others seize up at the worst moment. This is how inequality inside markets forms, not between rich and poor, but between what can move and what can't. Standardized assets keep flowing, everything else gets stuck, and it doesn't feel dramatic. It feels like delays, like spreads widening, like being told, not right now. That's the human impact, not collapse, friction, confusion, and quiet disadvantage for anyone caught on the wrong side of liquidity. If this feels familiar, say so in the comments, because once markets start teaching these lessons, they usually don't stop halfway through. Outrage doesn't explain this phase, mechanisms do. When stress builds, systems reveal what they actually reward. In this case, the incentive structure is clear. Anything that depends on trust, coordination, or smooth operation becomes fragile. Anything that stands outside the system gains leverage. Pricing mechanisms are fragmenting. Reference prices no longer align cleanly with physical reality. Different parts of the market respond to different signals at different speeds for different reasons. That fragmentation isn't chaos, it's adaptation. When a system can't process pressure evenly, it reroutes it. Power shifts toward assets that don't need consensus to function. This is why volatility feels asymmetric. Prices don't move smoothly. They gap, they pause, they reset, and then they hold. Not because of emotion, but because the plumbing underneath is under strain. Here's the unsettling insight. The system isn't failing. It's optimizing for survival. And survival means reducing exposure to promises, projections, and intermediaries. That's why physical constraints suddenly matter more than narratives. Why access matters more than price. And why assets that can exit the system quietly gain influence without asking permission. Once you see that, the behavior stops looking irrational. It starts looking intentional. From here, the path forward splits, but neither direction is calm. One path is controlled adjustment. Prices continue rising in steps. Pullbacks get bought quickly. Supply strains stay manageable, but never resolve. Silver holds above levels that once seemed impossible, and volatility becomes the new baseline. Markets adapt slowly, and people recalibrate what normal means. The other path is acceleration. A disruption hits at the wrong moment. A policy delay, a supply shock, a liquidity freeze. In that scenario, prices don't climb, they jump. Access tightens, premiums detach, and the gap between paper value and physical reality widens fast. Both paths are already visible in fragments. Elevated prices holding firm, bottlenecks forming, demand refusing to cool. Which path dominates depends less on intent and more on timing. Small events matter more in stretched systems. Here's what makes this phase dangerous. Decisions are being made now based on assumptions that worked in calmer cycles, but momentum is already forming, and once it tips, reaction time shrinks. The next move won't announce itself. It will emerge from something that looks minor at first, and by the time it's obvious, positioning will already be locked in. Here's the insight that ties all of this together. What you're watching isn't a metal story. It's a signal story. Prices aren't rising because people are excited. They're holding because confidence is relocating away from systems that require coordination, credibility, and perfect timing, toward assets that don't. Silver above 50 isn't the headline. The headline is that it stayed there. Gold above 4,000 isn't the shock. The shock is how quickly that level stopped feeling extreme. That's how transitions happen. Quietly at first, then all at once. This cycle won't end with a single crash or announcement. It will end when people realize the rules changed earlier than they thought. And by then, the easy positioning is gone. If you want to understand what comes next, not after it happens, but while it's forming, that's what this channel is for. Follow, subscribe, and stay close, because the next layer of this story is already taking shape.